Could I just stop you there, because for some of our audience may not understand what an annuity is. Can you tell us, simple terms, what is an annuity?
In layman's terms, an annuity is a product in which it's sold by an insurance company, and you buy this product where you have a contract with the insurance company that will offer you a guarantee of income from the premium that you, use the word premium, from the monies that you place into this product. Okay. There are liquidity options available for you. So there are, you can have it such that the monies are passed on to your children and your grandchildren. And so it's a great product to have to supplement Social Security. It is the only product that offers you a guaranteed income. Wow. It's guaranteed, just like Social Security. It is, you have a worry-free retirement, and you know that check is coming month after month, month after month, year in and year out.
As long as you live.
As long as you live.
So talking about retirement makes me think of something. I spent a little time going over your website, and I really enjoyed it. I'm going to go back and spend more time, in-depth time. But the short time that I was on it, I was intrigued by some of the bloggers and some of the comments about retirement.
Yes.
And it made me think about during the years when I was in mortgage. I was a mortgage professional. And people would go into their retirement and take out money to buy a house. They take out money for college education for their children. They take out money if they got in a tight and they needed, you know, to take care of a credit card or whatever. Yes. And I was wondering, what's happening? I mean, is that something that's advisable to do? Well,
you know, a lot of people have done that simply because the interest rates on credit cards and other instruments, excuse me, is pretty high. Now, I don't advocate borrowing or taking monies out of, and I've seen a number of folks who have borrowed money from their employer-sponsored retirement accounts. Now, let me define that. That's your thrift savings plan, which if you're a federal employee. A federal employee. 401k if you're in the private sector. There's the, well, of course, the TSP, or I should say that the thrift savings plan is referred to as a TSP. Your 403b for your educators who have that type of employer-sponsored retirement accounts. Now, the employer-sponsored retirement accounts have limitations. And when you go into get a distribution from your employer-sponsored retirement account, and I'll refer to it from henceforth as qualified plan, there is a withholding of approximately 20%. Now, something else too, there's risk involved. Usually
20%?
If you take these monies out, alrighty, get a distribution from an employer-sponsored retirement account, there is a 20% withholding that is done. So if you took $100,000 out of there, you get $80,000. That's automatically done. Now, I want to share with you, there are several ways in which you can get a distribution without any penalties, but there's a risk. The first is if you're a first-time home buyer. Okay, you can take up to $10,000 and get that. Hardship is another. You can borrow.
When you say hardship,
if there's some type
defining hardship?
Well, it will be defined by the program itself, the HRA, in which
so it could change,
yes,
depending on the employer, what they consider to be a hardship.
Exactly. So you may, and then you can. The risk is that another risk, I should say, is that if you borrow the money, you have up to 5 years to pay it back. Now, suppose you're separating from service. Well, if you don't pay this money back, the money that you have borrowed already, so what happens to you? You have 30 to 90 days to pay the money back, alrighty, and or else that distribution is subject to taxation as ordinary income.
Oh, no. So that's an additional
And so
on
that's
top of what you've, oh, wow.
So there's a risk there. So I'm not an advocate of borrowing or taking money from an employer-sponsored retirement account. What I do like is the opportunity. I help many a client roll over these monies, a non-taxable event, into an IRA, whether it's a traditional IRA or a Roth IRA. Now, something else too, I make sure, we were talking about annuities earlier. If we roll over these monies into an IRA, that is an annuity, that's an IRA. I also look into the suitability of those annuities and that rollover. Suitability meaning that I help the clients with the budget already. We set up an emergency fund. We prepare for that because, like I've said in so many, I guess, presentations that I've given, is that you don't want to use your retirement dollars for or as an ATM machine.
Right.
Alrighty. Now there are liquidity options available such that you can get monies from that IRA, and that does eliminate that 20% withholding. Now there's a 10% penalty if you're under 59 and a half, whether you get the monies from your employer, sponsored retirement account or qualified account, or if you get the monies from your IRA.
So let me see if I understand. You're saying that if you're under 59 and a half and you try and take money out, that there is an additional penalty.
Yes.
If they allow you to take it out.
Yeah. Now some employers allow what we call either with the federal system, federal government is age-based transfer. That is, you can retain your employment, you're 59 and a half, and you can roll over your thrift savings plan into an IRA. In the private sector, they call it not age-based. I think they refer to it as, my memory serves me correct, in-service transfer, so that you can roll those funds over into an IRA, and that gives you more flexibility and more control as well. So, I've done a great service for many a people, many a person, with their handling their assets, or I should say their nest egg, keeping it safe,
Right.
rolling it over, and also preparing the nest egg, that IRA, such that it will provide an income not only for you, but for your spouse,
Oh, wow.
your children, and your grandchildren.
Wow.
Set up what we call
Well,
multi-generation.
I have a question. What if it's a person that has been working, say, for 15, 20 years, they're not at that 59 and a half threshold, but they want to take money out and roll it over into a fixed annuity. Are they allowed to do that because of their age, or do they have to wait until they're 59 before they can do that, can do a rollover?
Well, let me share this with you. We have some young, today there are very few pensions. As a matter of fact, in
That's true.
1985, about 90% of all the companies in the U.S. offered a defined pension program. Well, by 1987, I should say, no, 2007, only 29% of the companies in America offered a pension. It's even a smaller percentage now that offer pensions. In other words, our young people, and I have adult children in the workforce, they're not offered that type of benefit of a defined pension program. They have to open up a qualified plan, a 401k, or a thrift savings plan if they're part of the government. Now, answering your question, I wanted to preface that, is that there are young people that more or less change jobs. They have contracts and they leave a trail of 401ks or qualified plans behind. Those monies can be rolled over because they separated from service and they're under 59 and a half.
Right.
Now, what is interesting too, let's suppose the young person or an individual who is a boomer under 59 and a half needs income, has a 401k in between jobs. And they say, well, I've got to have an income. What do I do? Well, there's a rule, an IRS rule called the 72T, whereas you roll over the qualified plan, the employer-sponsored retirement account, into an IRA, and there is a distribution from your nest egg, and you get what we call reasonable interest. And it is either 5 years or 59 and a half, whichever comes first. You'll receive a distribution from your IRA now because you have control of it. All right. And you do not, your nest egg is not subject to the 20% withholding.
Wow.
It is distributed as ordinary income.
And this is a new